Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Diego Parrilla. He is the managing partner of Quadriga Asset Managers. Diego has over 2 decades of experience in the commodity space. Diego, welcome to Wall Street Silver.
Thanks for having me, Ivan.
Yeah, it's a pleasure.
Well, thank you for joining us, sir. We really appreciate it. You're very knowledgeable about what's going on with Fed policy and what we're seeing right now in Japan and the UK and the European Central Bank is they're effectively doing yield curve control. And I guess the big question a lot of people have is the United States the next one to fall, where they just have to, they've got to go back to this in order to stop. What's the next step of this set of dominoes that's likely to fall here?
Well, really good question. I think what we're seeing is QE in a way was the way by which central banks were given, Mr. Powell, here's 120 billion a month, go and spend it. And that QE, which was global, obviously had this tremendous effect by bringing yields low, putting our valuations artificially high, kicking inflation. And if you give people the ability to borrow at zero or negative nominal yields, as has been the case with trillions of money, then people will take it. And guess what? You build this huge amount of debt, and there's a point that you do that on the complacency that rates will stay low, that inflation won't be an issue, blah, 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 and then things happen, right? And so what we're seeing with Japan is kind of leading the way of yield curve control, as you said, which I think is the single most important acronym to watch going forward, because it's effectively a different dynamic. QE, they give you the 120 billion a month, go and buy stuff. Here is you have infinite amount of money. Just make sure the yields don't go too high and the bubbles don't implode. And what we're seeing in Japan is how this process, the day they tapped into yield curve control for the first time, dollar yen just went, and since then we've seen dollar yen going from 115 to 150 in what is basically a spiral of currency devaluation and inflation. And this is a major problem. It's difficult to stop it. They're trying to intervene, but they're doing it unilaterally and without a lot of success. Mm-hmm. And obviously, as you mentioned, UK, China, and others are trying to do the same. The US, in a way, is kind of looking the other way, saying, guys, this is a bit of a problem of your own doing. Everybody has the same problem. But this domino effect, as you mentioned, is letting the weakest and most leveraged players go first. And in that sense, whilst the US suffers from a similar issue, I think it's in a better position. Now, mm-hmm. Looking at Europe and the ECB, I think it's a very clear example. In the previous meeting, they hiked 75 basis points in a clear recognition, in my view, that we're going back to positive nominal yields, recognition that perhaps negative yields was a huge mistake, which I think is the case. But then perhaps there's no turning back to zero or negative, in my view. I think something like 2% will be the new zero. But interestingly enough, as they're hiking rates, i.e. they're putting the foot on the brake, they're also simultaneously saying, guys, I'm not going to let this thing get out of control. Mm-hmm. Let's introduce this new tool, which is called anti-fragmentation, but it's de facto, Jim, a yield curve control. And the fact that people are not paying too much attention to it yet is because it hasn't been tapped, but it's ready. And I think that impact arguably is much more about removing that tail. Obviously, there's a big difference trying to contain yields at 25 basis points, as is the case in Japan, or trying to contain the yields at 4.5 or 4, as it might be in Europe. So I think yield curve control is needed, will be used, will be global, and ultimately what it means is you have this spiral of inflation and currency devaluation, which is a bit difficult to stop once it starts.
So the United States, I mean, you're already seeing it happen, as you've just said, in the United Kingdom, in Japan. The ECB is ready to do it in order to bail out Italy, Greece, Spain, and those countries if their debt spreads get too out of whack compared to German bonds. But I think the big question for, we're Wall Street Silver, we care about silver and gold and and the mining stocks and those things all affected by all these topics. It's not helping the United States what's going on with these other currencies. It's messing up our trade relationships. It's messing up our ability to export if the dollar gets too strong. So is there some pressure on the Fed to not let the dollar get too strong? Or is the Fed just like, oh, we don't care, we got to take care of, inflation here?
Well, I guess you're correct. I think the previous currency wars were all about competitive devaluations, right? So let me devalue my currency. I am competitive. Please send me your money, your technology, your employment, your everything, right?
Mhm.
And the mirror image to that, the defense mechanism was trade wars. So you want to devalue by 20%, I will tariff you by 20%. And this dynamic has been in play for decades. But this time around, things are different. This time around, the currency wars are becoming much more about payback time. And in some ways, as you say, you're effectively exporting inflation. So the US, it's a lot more relaxed about a much weaker yen or a much weaker, basically, euro or yuan. And they are, if you think about the details, previous central banks interventions when I started my career almost 30 years ago, they were actually done on a multilateral basis. These interventions were like, okay, guys, we agree, the market's a bit gone, and let's go and intervene. This recent round of interventions are unilateral, and that's proven to be fairly ineffective, and they're using very precious dollars to do this. So I think in that sense, the Fed, for the time being, is much more worried about effectively the inflation problem than it's about exports. In fact, taking a more brutal view of the world, I think the U.S. is destroying, or some of these countries are imploding partially because of their own abuse and wrongdoing with monetary and fiscal. So, it's hard to say exactly when enough's enough. But I think the current pace of hikes led by the US and followed by ECB and others, these so-called jumbo hikes, all it does is it kind of reinforces the extreme incompetence and negligence of central banks leaving rates way too low. Monetary policy was never designed to do very fast 75 basis point hikes, meeting after meeting. This is, I think, something that is bound to break something. In fact, many areas are already broken, and this could happen either domestically or abroad. And in my opinion, things are more likely to break abroad because those who were effectively forced to borrow in dollars, nobody would lend you in your own currency, are now facing the triple whammy or quadruple whammy of, look, I need to repay more dollars, a bigger amount in local currency with the strength of the dollar. I need to do it at higher rates when access to the markets is getting harder, et cetera, et cetera, et cetera. So I think to the extent that monetary and fiscal policies, abuse has led to certain complacency in many areas, this is leading to more havoc. So how far will this go, and at what point does the Fed and the U.S. worry about, the rest of the world? Is hard to say, but I suspect, further weakness in the euro or the yen or the yuan is to come, and it could be quite significant. And I think all these drivers, ultimately back to your question on gold and precious, this is effectively a spiral of devaluations and inflation. And in the short term, things like gold or silver look more expensive in local currency terms, which destroys demand or could even create some supply to the market. But as a structural beast, I think it just shows we need alternatives. And I certainly believe precious metals in general, and gold in particular, is one of the big winners.
So Diego, has gold bottomed, and what's the trigger or the next catalyst for silver and gold to take off?
Well, look, certainly the current trend has been down. It's been very difficult. We know why in some ways, the strong dollar, the increase in nominal yields the perception that inflation will be contained, and the trend and what it means for flows. I actually think many of these things are likely to reverse and potentially soon. Plus, there's several other factors to watch. The dollar market is currently looking at the sort of peak hikes into Q1 2023, so around the corner. And generally speaking, this might be giving some comfort to people that are short gold as a way of, look, I still have some time to get out. But I think the potential sell-off in the market, whether it happens domestically or externally, could come to an early pivot. I think that's one thing. The second is on the direction of nominal rates. The market's already predicting the pivot to actually bring things down over time. I would agree with that, and perhaps we might see the necessity to do that, not quite all the way with yield curve control in the US, but certainly they need to support depending on the severity of what's happening. And I think there's several other things the market might not be fully appreciating. On the inflation side, as we discussed earlier, I think yield curve control is consistent with structurally high inflation and deeply negative real yields. And this is something the market has completely the other way around, in my view. And it's extraordinarily difficult that we get this right, investors get this right for the outlook. But I think beyond the dollar turning, peak rates, inflation expectations, I would highlight also the possibility of a credit event. We've already seen in some ways things happening. We were saved by the bail of the Bank of England in the UK, and I think these huge moves are obviously creating a lot of strain. And there are people that are arguably already dead. We just don't know them. There's a lot of stress. It might be a matter of time. So watch out for credit. The other thing we need to watch out for is volatility. This last 18 months, have happened to a number of people's surprise. It's been a relatively uneventful space for volatility, at least on the equity side and the VIX in particular. Where the sell-off in equities has happened in a much more trendy line with the VIX holding around 30. Watch out for the VIX breaking higher levels, and I usually look at 40 as a line in the sand, because this is, using the analogy of fluid mechanics, we move from a linear regime, laminar regime to a turbulent. Things really go out of control once vol spikes. This is mechanical process of higher volatility leads to higher value risk, forced liquidation, thinner liquidity, polarization of correlations, and this kind of feeds back. And last but not least, I think watch out for geopolitics. Obviously, we all know what's happening in Russia, Ukraine. I think there's increasing concern perhaps around China and other places. But I personally, I'm much more worried about some miscalculation in Russia, Ukraine. And I think there, even the possibility of a nuclear, kind of, they're talking about smaller, almost like mining type of bombs, that they're not really a big scale. But I think once we start playing with on both sides with fire, this could actually escalate in a really nasty way. So I think under all circumstances, whether it's a credit, volatility, geopolitics, dollar, etc., gold, in my opinion, offers a very asymmetric risk-reward profile. And this is obviously in dollars. If we look at gold in any other currency, then I think it's obviously already been performing stronger overall, but I do think that bottom might be near. And whilst I don't have a crystal ball, and it's very tricky, all I would say is just mind your leverage. I think that's something everybody should be careful about. Volatility is going to stay very high, and so trying to pick these bottoms and do it in a leverage basis is extraordinarily dangerous. So I just say, look, there's reasons to be optimistic for those that have been in there, but I think leverage is your enemy, and in a high volatility environment, even if you're right, you could be wrong.
Well, what you just said about credit events. Just recently, this was announced, is Credit Suisse, which seems to be the sickest. I don't want to say it's the current Lehman Brothers or Bear Stearns of the current financial system, but it seems to be the sick one out there that everyone's talking about. The Fed is doing massive swap lines to the Swiss National Bank, and it's rumored to be so the Swiss National Bank can bail out Credit Suisse. And just recently, this was announced, Credit Suisse is selling all sorts of assets, massive job cuts, trying to stay alive, raise billions of dollars to, I guess, replenish their capital. Their stock price is in the tank. Relative to the size of this bank, their stock price is negligible. What's your thought? Is this the Lehman Brothers of our times?
Well, I think this time around there are just so many open fronts, and I think some of the risks we are seeing, like in the banks, are relatively well understood. I think it's events more like the hidden leverage that suddenly appeared in the UK, in the pension system, and many others that we may or may not fully appreciate yet, that are way bigger. My view is the Lehman is actually China. I mean, China is the one. China is the biggest bubble in financial history. Full stop.
Wow. You're referring to the real estate development market there?
The whole thing. The whole thing. And the thing about this dynamics, and then we'll go back to Credit Suisse, is that we know how this works, right? With governments, you can basically you can do whatever you want. You can bail people out. You can spend your way out. You can borrow. You can nationalize. You can do anything you want. But we know that ultimately the degree of freedom in the system, it's always 100% of the time the currency. So think about the historical examples, whether it's Zimbabwe, Argentina, or Turkey, or in some ways now Japan or others. I think if you abuse monetary and fiscal policy, the currency. And so I think the degree of freedom for the yuan, for China, is the yuan. This is something to watch. I think it has major second, third, fourth order effects across the world, and the world's been relying on China and continues for multiple things. When it comes down to the banks, I would agree with you that whilst I think Credit Suisse is an institution that's been around for the longest time, and they are perhaps one of the, if not, one of the leading private banks in the world. My humble opinion is some of these banks are a bit conflicted. Do we want to be a private bank? Do we want to be an investment bank? And I think UBS is the same. They perhaps when they stick to their core business, it's still very healthy and very good. When they get involved in other things, perhaps things go a bit worse. So I think there's no question to me that the governments will intervene. And they can save them. So I'm a lot less concerned about the specifics of a Deutsche or a Credit Suisse, because they're known and they're going to be bailed out. It might not be good news for the equity holder or certain credit guys, but they're not systemic in the way that they will be. Things will, in my humble opinion, it's not necessarily the biggest problem. But there are many others that are out there that are just too big to fail. And those are too big to fail. And I pointed out on China simply because of the sheer size and the implications on a global scale. Right. But there are many other pockets of areas, including hidden risk that we may not fully appreciate today. And with the benefit of hindsight, we'll understand better. But this crisis are always the same. You have some areas that are relatively easy to predict and very obvious leverage, which will be taken out. Mm-hmm. But the danger one is what you think you know and you don't really know. And so I think those pockets is what could surprise the market, lead to these events, and ultimately I think going back to volatility and geopolitics and things like that, it's those surprises, those shocks that lead. If Credit Suisse went off, I don't think the VIX will blip that much. Okay, but if something happened that is not quite being watched or anticipated, and the VIX goes, suddenly you get exposure, and you will see other pockets of hidden leverage that were not so obvious. So I just think we need to be cautious and be mindful that our visibility of what's happening of the world is limited, and there are these decades of monetary and fiscal abuse have created a brutal amount of excess and hidden leverage that it's there. It's a case of pre-existing fragility, as they say in economics, and I hope I think again this will show up under certain circumstances, including a very meaningful volatility blow up, which is something that we want to watch out as whatever the cause is, that would expose many of those imbalances.
Well, Diego, thank you very much for joining us. This has been very, it's been great talking to you. You're very knowledgeable, and we'd love to hear from you again in the next few months.
Yeah.
My absolute pleasure, guys. All the best, and congrats on the great job.
Thank you, Diego.
Thank you.